Hi everyone, you're welcome to another class. So today we are going to be discussing capital asset pricing model. Remember in our last class we did an introductory class for cost of capital where we explained cost of capital, the types of cost of capital, which is cost of equity, cost of debt, then the method of evaluating cost of equity, which is Capm and dividend valuation model. So now starting off is cost CAPM. We're going to start with CAPM method of evaluating cost of equity. So CAPM means capital asset pricing model. So when talking of capital asset pricing model is a method of evaluating cost of equity. You understand? So this method puts into consideration the risk. You understand? The risk that is associated with businesses and all of that. So the formula is KE is equals KE is equals to RF plus BE RM minus RF, right? Or KE is equals to RF plus BE brackets risk premium. Yes. So now where KE is equals to cost of equity, RF is equals to risk free rate, BE is equals to beta of equity, RM is equals to average, that's market return. You understand? Like market return, that's average market return. But in the course you are going to see it as market return, but it also means average market return. Then this RP for the second formula, RP stands for risk premium, which is risk premium. So this risk premium means that RM minus RF, you understand, it will give is equals to risk premium. So why we have these two formulas is because of the fact that there are some questions, right? They are going to give you this return, this market return. Yes, there are some questions they will give you market return. There are some questions they will not give you market return. They'll just give you risk premium rate straight. So it means that this risk premium means that it has computation has already been done already. You understand? Is RM minus RF, which means in the market return, RF has been, that the risk free rate has been deducted from it already. So in the question, they'll just give you risk premium. You understand? So if they give you the risk premium, that means you are going to use this formula. But if you are giving market return, you use this formula. You understand? So now, when we're talking of, like in our last time we explained cost of equity, what cost of equity means. So now we want to explain risk-free rate. So we're talking of risk-free rate. Risk-free rate is like a percentage in like the return that we say cost of capital is the minimum return an investor expect from their investment. So now if for instance an investor expect 10%, right? So out of this 10%, 5% of it is risk free. That's the risk free rate. It is like a percentage from an investor expected return that is free from risk. Do you understand? It's free from risk. If an investor expects 10%, what of that 10% is free from 5%, that means that 5%, sorry, out of that 10%, 5% of it is free from risk. It means that the other 5% is the risk-free rate. You understand? So now we also move to beta of equity. So we're talking of beta of equity. Beta of equity is like a concept, you understand? Because we also have beta of assets. But beta of equity means that a company finances its project with combination of debt and equity. You understand? So which means that that company is highly geared. So if a company finances its project with debt as well as equity, it means that that company is highly geared, yes, or is a leverage company. So that's what better of assets is talking, so better of equity is talking about. But on the other hand, when we're talking of better of assets, better of asset, if a company uses only equity, do you understand, only equity, that's the ordinary share capital, you understand, to finance its project, it means that the company is using its assets to finance its project, which means that the company is not geared, is not like, is not leveraged, you understand, is not geared, which is very very good. Yes, it's very very good. So now we also talk about um RM, which is market return, of course, average return. Then RP, which is the risk premium. I've explained it earlier. In a question, if you are giving risk premium, which it means that this computation has already been done, so you just go straight and use this formula. But if you are giving market return, it means that you are going to use this formula. So yeah. So we are still now talking of better on equity, right? BE. BE, we have business risk. BE is divided into two. We have business risk and we have financial risk. Now, the question is, what is business risk? Business risk is are those risks that that can affect a business profitability level. You understand? They are those risks that tends to affect a company's profitability level. So it is divided into two. We have systemic and unsystemic. Systematic risk and unsystematic risk. So we're talking of systematic risk. Systematic risk are risks that affect, you know, companies in a given industry. It means that that particular risk affects all the companies in that industry. You understand? It's like industry based risk. A perfect example is like regulations, like government regulations. You understand? Because of course a particular industry has their own regulations. You, yes, have their own regulations. And when such regulations are not being adhered to, right? So those companies tend to what? Face it. So it's industry, these systemic risks are risks that are peculiar to industry, all the companies in that industry, in the whole of that industry. Then unsystematic risk are risks that are peculiar to companies. You understand? That peculiar to companies. Example, operational inefficiency, internal control problem. Those ones is, you understand, is internal, is within the company, is specific to the company, not general, and not the whole of the industry. Like is peculiar to companies, right? So these systematic risks are unavoided risks. They cannot be avoided. You understand? But you just have to find a way to manage because it affects everybody in the industry. But this unsystematic risk, they are risks that can be avoided. Yes, you can avoid it. So that now leads us to the other type, which is financial risk. So we're talking of financial risk. Financial risk is used to measure the proportion of debt that is in a company's capital structure. For instance, let's say a company has a total capital structure of 100 million, right? Of 100 million. Out of this 100 million, 50% of it, 50% of it, which is 50 million, is debt, right? Is debt. This means that the company finances its project both with equity and debt. You understand? Because of this 50%, that means debt is constituted already, which means that the company is highly geared. Yes, it's highly geared or leveraged. The leverage company. Then with this, so this that's beta of equity. Remember we said that beta of equity is the combination of both equity plus debt, when a company uses both equity and debt to finance a project. You understand? Then we now also have better of assets. I explained it earlier. We now also have better of assets. Better of assets means that the company they only uses their equity to finance their project. They know they do pass themselves. You understand? Which is very, very good. Better of assets. It means that the company is not highly geared and all of that. So now we're also going to, hope I'm not too fast though. Please, if I'm too fast, kindly drop a comment so that I can slow down. So we'll now also talk about the assumption of capital asset pricing model. Assumptions. One of the assumptions is the fact that capital asset pricing model, believes that investors are risk averse. Yes, they believe that investors, like, they want higher return with low rate, with low risk, with low risk. Is that even possible in real? Is that even possible in a real sense? It's not possible, because when it comes to investment, investors, they have big appetite for risk. Yeah, they have big appetite. They know that, okay, because they believe that the higher the return, the higher the interest, the higher the risk. You understand? They believe that they are willing to take that risk. Okay, we said risk, investors are risk averse. Number two, but in real life, this is not true. It's not true. We said that homogeneous expectation. So the Capm also assumes that there are homogeneous expectation, meaning that all the investors has the same expectation in terms of information, in terms of information about the market, everything. They have the same expectation. And you ask yourself, is this even true? It's also not true, but it is an assumption. We'll work with it like that. Number three is that um number three, he said that investors also, like, there are no transaction costs. That he said, the Captain also said that there is a perfect market condition. Perfect market. Perfect market means that there is no taxation, there is no dealing costs. You understand? Everything is just running smoothly. And you now ask yourself again, is this true? It is also not true, but it is an assumption. We are also going to run with it like that. You understand? So that's just basic. This is just the summary. That's basic. You read it. You please try to read further on this. So now we are going to move straight to solving our questions. We are going to solve ICANN November Pathfinder. November 2018, question 1. Capm. So we are going to solve our first example now. The question, it said on May 31st, 2017, Echo's ordinary share had a market value of 276 kobo SDIV and an equity beta of 0.6%. Sorry, of 0.6. Equity, that's our BE. 0.60. So now when you read at it, when it comes to Capm, you're going to read some of this question that I showed, right? Some of those, there are some elements that are not even related. So just pick the one that suits the Capm formula. Do you understand? So now our an equity beta of 0.60, full stop. Then for the year ended May 31st, 2017, the dividend yield was 4.2%. That one, we don't need it now. And the earning per share was 25 kobo. We also don't need it. The return on the market, that's the market return. Okay, let me write the formulas again. That means it is the first formula we are going to use. Since we have market return in this question, we are going to use the first formula, which is this is the formula we're going to use. So the return on the market is expected to be 8% per annum. So 8% market return, RM is equals to 8%. Now, and the risk-free rate is 2%. And the risk-free rate is 2%. RF is equals to 2%. So now we're not going to, impute this in our formula. We'll now say, okay, KE is equals to risk-free rate, that's RF, which is 2%, plus BE, which is 0.60 bracket RM, which is 8% minus 2%. This is the risk-free rate. Now let's say, okay, KE is equals to 2 plus 0.60, then now say, okay, which is 6, right? Now say KE is equals to this times this, then plus this. 6 times 0.06, right? That gives us 3.6, then plus this 2, that's 5.6. So this means that our cost of equity is 5.6%. Is that clear? So we'll now move to our second question, where we'll have to use the second formula. November 2019, question 6. Sorry, risk premium. I said JP has an equity beta of 1.6. Equity beta, as BE is equals to 1.2. And SD market value of the company's equity is 1 billion. We don't need that information. The S interest market value of the convertible bond is 160 million. We don't need it. 168 million. We don't need it. And the dividend market value of the preference share is 50,000. 50 million. We don't also need that. So, okay, we'll now move down to this. Now, so the equity risk premium is 5%. The equity risk premium is 5%, which means they've already, from market return, they've already minus risk-free. You understand? So which now give us this risk premium. So we now say RP is equals to 5%, right? 5%, and the risk-free rate of return is 4% per year. Then risk-free is equals to 4% per year. So now let's solve it. We'll now say, okay, KE is equals to risk-free, which is 4%, plus BE, which is 1.2, then risk premium, which is 5. You see, we are doing it straight now. We are not minusing like the first one. So we'll now say, okay, 5 times 1.2 is going to give us 6%, 6 plus 4. So KE is equals to 10%. Yes. So that's all about that's all about cost of using Capm, the capital asset pricing model. So in my next class, we are going to be discussing on dividend valuation method. Yes, the use of interpolation and Gordon's growth model. So please kindly do well to subscribe, like my video, share to your friends. Thank you, and see you all in my next one. Bye bye.